Hello everyone, welcome back to my channel. If you're new here, my name is Layla, and in this video, we're going to be talking about the Silicon Valley Bank failure and whether or not you should be worried about your money in your bank account. You've probably seen a lot of information and news around the SVB failure, and I hope that that has not affected any of y'all, but I know that some people are now concerned about trusting their bank. Should they pull their money out of the bank? I've actually had a couple of questions around this, so I wanted to address that and really just talk about what happened with this failure, how this happened, and how a bank fails in general, because this isn't the first time this has happened. And then I'm going to talk about why you probably shouldn't be too concerned and what you can do to protect yourself. Before we jump in, I do want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. Y'all know how much I love learning more about finances, so I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. As of March 13th, 2023, Stock Advisor recommendations have returned an average of 366% since inception of the service. Go to fool.com/Layla, that's fool.com/LEILA, to get your 10 stock picks now. All right, so first up, let's talk about what actually happened with Silicon Valley Bank. Silicon Valley Bank failed, and this was the largest bank failure since 2008. Back in 2008, there was a large bank failure through Washington Mutual, and now Silicon Valley Bank follows second behind that. To understand why this happened, I want to explain a little bit about how banks actually work and operate. So you as a customer, you would open an account with any bank out there. It could be a large bank like Chase, Bank of America, Wells Fargo, etc., or it could be something smaller and more local. So maybe it's a local bank that is only in your state. But either way, what happens is you put your money into the bank, right? Let's say you have $5,000 in your account. Now the bank is a business, so they do need to make money somehow. And yes, they do lend. They lend out loans, lend out mortgages. They have credit cards, so they're getting money from interest. But they also make money by investing. So they could invest in stocks. A lot of times they're investing in government securities. So this could be like treasury bonds. Sometimes they're investing in commercial real estate, so on and so forth. And then a little bit they hold in a cash reserve. So with that same example, if you have $5,000 in your checking account and you need to go take out $5,000, you would be able to do that in the same day. So they're not going to take everybody's money and invest all of that. They do keep a cash reserve. So this is like when you go to the ATM and you pull out $100 or a couple $100, you're able to get that right away because there are cash reserves and not all of their dollars are tied up. This process is completely normal. That is what happens with your money. Otherwise, they would not be able to pay their employees. They would not be able to pay us our interest on our, high yield savings accounts and such. But what happened with SVB is a little bit different. So with SVB, a lot of the customers with this bank were in the tech sector. A lot of their customers were startup companies in the tech sector. So a startup typically has a lot of money to start with. They may get some venture capital funds or some financing that's worth $100 million. So then that startup needs to put that money somewhere. So a lot of them chose SVB. Now SVB, while they did have cash reserves, they did invest and put the bulk of their money into US Treasury securities. And when they purchased these securities, they bought them for a specific amount, some, $1 billion, $127 billion or something. But then by the end of December 2022, that was not worth as much as they had purchased it for. So basically this is like the stock market. They purchase, let's say you buy a stock at $100, but then by the end of the year, it was down to like $80. So if you were to sell that stock, then you would be losing $20. Obviously, that's a much smaller scale of an example, but that is what happened here. And that is exactly what was reported from SVB. Now, of course, these customers and startups that use SVB were told this news. They did become aware that the bank was in a little bit of trouble. They decided to start pulling their money out. So this could be, hundreds of millions of dollars pulled out from the bank account so that they could put it into a different bank. And this kept happening. So it wasn't just one company, it was multiple. And of course the news continued to get out, so this just continued to happen. And if that's the case, then SVB is going to use their cash reserve that they have, but they probably ran through that pretty quickly, and they did go ahead and sell off what they could. But because the market was down, those assets were down, they did not have enough money to cover what they needed to. So if somebody needed $100 million after they already depleted hundreds of millions of dollars to their other customers, there was no more left for that specific customer. The problem here too is that if you put $100 million into a bank, only $250,000 of that is FDIC insured. So if you put in, $100,000 into a bank, you should be good. You're going to get your $100,000 because it's FDIC insured. But $100 million, that's a different story. And the bank, they still have, they probably have mortgages out there, loans out there, whatever. I don't know the specifics of what they exactly lent out. But that is not liquid money. So people still owe them money, but the money isn't going to be repaid just immediately. So obviously this caused a huge problem because now there's no more money left for people to get their money out. It is very unfortunate. A lot of people lost a lot of money. A lot of companies lost a lot of money. And of course, they're still dealing with that. Most individuals who use that bank should be okay. If you had $10,000 in the bank, you would probably be able to get that out because it's FDIC insured. Even if it were to be delayed, you would eventually get your money. But for these startups that had millions of dollars in this bank, they may have to go out of business or they may not be able to pay their employees. So now the question is, should you be worried about your bank and your assets? In short, the answer is no, probably not. First of all, I want to point out that bank failures are not that uncommon. So from 2001 through 2023, there have been 562 bank failures. This one was a big one, as well as the failure with Washington Mutual in 2008. But overall, this is a pretty common thing to happen. And if you check out the FDIC website, which I will link down below, you can literally go through all of the years and see all of the banks that had failed for that year. There are some years that there were no banks that failed, specifically 2022, 2021, no banks had failed. But if you go ahead and check these out, you'll notice something similar about all of these. The banks that have failed throughout the years are primarily small local banks. So if you look through this list, you're not going to see Bank of America. You're not going to see Chase. You're not going to see Goldman Sachs. Because as much as, people may hate on these larger banks, which, I don't like to store too much of my money with Bank of America. I do bank with Bank of America. I bank with Chase. I bank with Wells Fargo because, I take advantage of bonuses and such. And a lot of people hate on these because of their fees and, maybe their customer service or whatever. But your money should be good in those larger banks because these banks have a lot of customers, a lot of money. They diversify where they put their money, and they've been in business for a very long time. So what I would suggest, if you are banking with a smaller local bank, that's something to consider. Like maybe you don't want to bank with them anymore. And going along with that, most banks, basically every bank at this point, is FDIC insured. Typically, it's insured up to $250,000. So 2 points with that. Go ahead and make sure that the bank that you are with is FDIC insured. If it's one of those big banks, definitely Bank of America, Chase, you're good. But if you're using a smaller local bank, just be sure to double check that it is FDIC insured. And then the second point with that is I do not suggest holding more than $250,000 in an individual bank because if any of that money is lost for whatever reason, then only $250,000 of it is insured. So if you have $250K in one bank, cool. Then the rest of it, go ahead and open with another bank. And one final tip, if it will help you sleep better at night, is to put your money in multiple places. So sure, you can have some in cash. Personally, I don't like to have any cash. It's just not something that is part of my plan. But I do have my money spread in multiple places. So y'all know I have multiple checking accounts, multiple savings accounts, and that is to take advantage of bonuses, but I do like to have my money in different places, just in case. No, I don't expect this to happen to larger banks or the places that I keep my money in, but if it's going to help you feel better about your money and where it's held, then be sure to put it in different places. So you could put it in a couple of different checking accounts or put some into a high yield savings account. And then that way, if one bank happens to go down, which again is very unlikely, but if something does happen to your bank, then you have money elsewhere while you wait for the funds to come in. So if you have $5,000 and that gets lost because of a bank failure, you're gonna get that money because it was FDIC insured. I don't know the delay time on that or if you can get it immediately, but you'll get that money as long as the bank is FDIC insured. As I said at the beginning, I hope this didn't affect any of y'all. I will say that now is a good time to invest in the market. You probably noticed that the S&P 500 went down and other index funds went down because a lot of chaos is happening in the finance world. So if you are in a place where you are okay with investing, you have the extra cash to invest and that is part of your plan, then definitely look into purchasing some index funds at the moment or some stocks. But yeah, hopefully this video helped to clarify some things about this whole situation and put your mind at ease in regards to where your money is in your current bank account. Any relevant links I will put down in the description box. If you have any questions that I did not address, feel free to ask those in the comment section, or if you have anything important to share about this situation, please feel free to pop that down below as well. Otherwise, thank you again to the Motley Fool for sponsoring this video. Please give this video a thumbs up, subscribe if you haven't already, and I'll see you in my next one.